Welcome back, and here's your latest housing market update. And thank you so much for joining me. I appreciate you. I have some big news to share because rates or mortgage rates decreased greatly today, which is Tuesday. So I'll share some information regarding that and why rates actually did decrease on Tuesday. Plus, I have some more reports I want to share with you guys regarding credit availability, consumer sentiment regarding our housing market, and also the likelihood of a future rate hike by the Fed. So, of course, I have a lot to share. Let's go ahead and dive right in. According to the Mortgage News Daily, as of today, which is Tuesday, the 30-year fix, again, for people with great credit, decreased 19 basis points. Now it's only 7.62%. Jumbo is at 7.85%, and FHA and VA is around 7.1%. 1 year ago this time, for a 30-year fix, we were at 7.12%. That's only an increase of a half of a percentage point. Rates, by the way, have been very volatile over the past 7 days here because when was this? On Friday, rates increased 12 basis points to 7.81%, the highest level since October of 2000. Now they have decreased by 19 basis points, now at about 7.6%. So overall, why did rates decrease? According to the Mortgage News Daily here, it says the outbreak of the Israeli-Gaza conflict, the terrorist attack that occurred in Israel, prompted some excess demand for safer haven assets such as treasury bonds and also mortgage-backed securities. So when demand for an asset increases, so does the price. And bonds have an inverse relationship between prices and yields. So when prices go up on the 10-year, for example, yields decrease. So take a look at this, because the yield on the 10-year decreased 14 basis points on Tuesday to 4.66%. And again, one of the reasons why the yield decreased is because prices for this 10-year bond actually increase. That is an inverse relationship in the bond market here. They also said here that perhaps more importantly, this conflict creates geopolitical uncertainty that is seen as one of the reasons for the Fed to wait and see and not to do any further rate hikes. So for example, according to the CME FedWatch tool, the likelihood of an increase of rates by the Fed actually has been falling, actually has been decreasing. This is the likelihood that the Fed will change the federal target rate or the federal funds rate in their upcoming meetings. The next meeting is in 21 days from now on November 1st. So look at this. This is pretty interesting here. The likelihood of a pause by the Fed in their next meeting next month is at 84.9%. The likelihood of a pause by the Fed at about 85%. 1 week ago, though, the likelihood was 71.8%. Also, for the likelihood of a 25 basis point increase, because the current rate right now of the federal funds rate is at 5.5%, the likelihood that the Fed will increase that rate to 5.75%, or a 25 basis point increase, is only at 15.1%. Whereas 1 week ago, before the conflict with Israel and Hamas terrorist group, the probability on that was at 28% 1 week ago. Now it's at 15%. On top of that, when looking at their next meeting, which is the last meeting this year, December 13th, the likelihood of another pause is at 71.6%. And only a 26% likelihood that the Fed will increase rates to 5.75%. And by the way, the expectations 1 week ago for a rate hike was at 39.4%. Now it's only at 26%. So big picture here, because of this conflict in the Middle East, this is actually decreasing the likelihood of a future rate hike this year. All right, let's change gears slightly here and talk about another report from the MBA here regarding credit availability. So credit availability more or less means how hard or how easy it is to get a loan approved to buy a house. So their index, which is called their Mortgage Credit Availability Index, or their MCAI, increased very slightly in September, an increase of 0.6%. An increase in their index means that credit standards are actually getting more loose, but it'll increase less than 1% here. According to Joel Kahn, who's the MBA's vice president and deputy chief economist, he stated the following. Credit availability increased slightly in September as lenders increased their loan offerings marginally to meet the changing needs of borrowers who are facing high rates. There were more loan programs for ARM loans or adjustable rate mortgages for borrowers seeking lower initial monthly payments, and also some increases in non-QM product offerings. What we don't want to see is for people flocking to buy or using adjustable rate mortgages to buy houses, because that is viewed as a more risky loan product. So for example, if you have a 5/1 ARM in which your rate is locked in for 5 years, but then after that it becomes variable, that's a risky loan product because you're not going to have your rate fixed for 30 years. And after that 5-year period, who knows what your housing payment's going to be like, right? And who knows if we're going to be able to refi your mortgage. What I will say though is I want to share this with you first though, because we're not seeing that just yet. We're not seeing a huge amount of people who are getting applications using an adjustable rate mortgage. According to the MBA, just posted about a week ago on October 4th, for the week ended September 29th, the ARM share of activity, these are the amount of people or the share of people who are submitting loan applications using an adjustable rate mortgage, increased to 8%. So only 8% of all loan apps to refi or to purchase a house was using an ARM or an adjustable rate mortgage. The reason why this has been increasing though, because I would say the low last year was around 3%. The high last year was around 12%. So we're kind of right in the middle of the range over the past 2 years or so here. So the reason why people are moving to ARMs though is this right here. According to the MBA last week, the average 30-year fixed rate was at 7.53%. But for a 5/1 ARM, again, fixed for 5 years and then variable thereafter, that was only at 6.49%, about 1 percentage point less than the average 30-year fixed. And therefore, because of that, your monthly housing payment, at least for those first 5 years, will be lower than this rate for a 30-year fix. In any case, let's get back to the MBA's report here, because this increased by 0.6%. Here's what it actually looked like going back to the year of 2011. So when the index is high, this means that lending standards are actually loose. When the index is low, it means that it actually gets harder to qualify for a home loan. So this is that small increase right now. So the current levels right now is more or less on par with levels going back to 2013. So in other words, lending standards still remaining fairly tight. Here's perhaps a better chart though, showing the index going back to the year of 2004. We are right here, more or less the lowest levels going back to 2013, or the tightest lending standards in about 10 years, which is obviously much different than the very loose standards we saw in 2004 through about 2007. So for example, right now for September, the index is at 97.2. The peak back in 2006 was approaching 900. Very loose lending standards prior to the Great Recession compared to what we're seeing right now. Here's yet another report I want to share with you guys as well. This is from Fannie Mae, just announced yesterday here. It says the primary reason why people are pessimistic regarding our housing market is mortgage rates and not home prices. According to Fannie Mae's Home Purchase Sentiment Index, or their HPSI, that actually decreased by 2.4 points in September, as elevated mortgage rates further dampened already pessimistic consumer housing sentiment. So for example, take a look at this. In September, only 16% of consumers who responded to the survey here believed it was a good time to buy a house. That is tied to the all-time record low that was set last year. Additionally, 63% believed it was a good time to sell a house, but that actually fell from the prior month. Also, only 17% of consumers indicated that they expect rates will go down over the next 12 months. Additionally, according to Doug Duncan, who is Fannie Mae's Senior Vice President and Chief Economist, he said the share of consumers expressing pessimism about home buying conditions hit a new survey high in September, with 84% now indicating that's now a bad time to buy a house. On the sell side, respondents of the survey here also listed unfavorable mortgage rates as a top reason why they believe it's a bad time to sell a house. This indicates to us that many homeowners are probably not eager to give up their very low rates and take on a 7.5% rate today. By the way, this monthly survey from Fannie Mae goes back to the year of 2010. So it's quite remarkable that we have tied for the all-time record lows for people who say it's a good time to buy a house, only at 16% right now. And on top of that, 84% believe it's a bad time to buy a house, an all-time record high. They also asked consumers regarding their expectations for rates and also job loss concerns as well. In regards to rates, the percentage of people who said that rates are actually going to go down over the next 12 months decreased from 18% to 17%. So only 17% believe that rates will decrease over the next 12 months. In contrast, 46% believe that rates will remain unchanged in the next 12 months. In regards to job losses, the percentage who are not concerned about losing their jobs in the next 12 months decreased from 78% to 75%. In regards to household income, only 18% said their household income increased significantly over the past 12 months. In contrast, about 68% responded saying their income is about the same it was about 12 months ago. With that said, please leave me a comment below with your biggest takeaways from today's video. Also, consider subscribing if you haven't done so already. Help me reach 100,000 subscribers by year end. I appreciate you. Hope you have an awesome day and look forward to seeing you on the next video.